Hello and welcome. In this recording, we are going to discuss about retirement planning. So, what is retirement? Retirement is beyond a certain age, you would not be working. So, there is no active income, but there still be expenses. So, let's say your work means I'm working in SAT, I'm working in a university right now. So, when I retire at the age of let's say 65, my expenses don't stop there, my income stops. So say means the university would not be paying me anymore, but my expenses still continue. And retirement planning is a process of meeting those expenses. So how do you plan for your retirement? So it's a simple process. The first step is you need to factor in what you have. So what assets you have. So you may have an house, you may have some investments. So you need to factor in what all assets you have and how these assets can be used when you retire. So how these investments can help you when you retire. For example, if you have a house, you can maybe sell it when you retire and move to a smaller one. Then you need to find out what you need. So in terms of expenses, what kind of expenses you will incur when you retire. Certain expenses will not be there, so you would not be working, so commuting will go down, then eating out will go down, but expenses like Medicare, then healthcare, and let's say living expenses, all these may go up. So you need to factor in what would be your expenses when you retire. Next is you don't have to plan for entire retirement. Some part of it would be covered through the government help. So government will be providing you certain pensions and fund flows. Then some part of it will be covered by your employer. So your means I'm working in a university, so I have a pension plan. So when I retire, I will start getting my pensions. Okay. So you need to figure out what are you going to get from employer and government. And finally, the last step is you need to plan for the rest. Now, in this entire process, the biggest threat is inflation. Inflation is once you retire, you have a fixed investment pool. That investment pool is not increasing with inflation until and unless you invest. So things will keep on getting costly, but your pension may not change. So there is an very real threat of your investments going down, your pension going down, and you may not be able to live the way you want to. So inflation is the biggest threat in this entire retirement process. So how do you plan for retirement? First, find out what you have, then find out what you need, what kind of expenses you will incur, then how much help are you going to get, and plan for the rest, and consider inflation while planning. So let's start. So why do you plan for retirement? Successful, happy retirement takes planning and continual evaluation. Planning helps you anticipate future changes and gain control over future. So you're independent. You have been independent in your working life. You would love to be independent even in your retirement. Rules for retirement planning, for example, government pensions and all, are constantly changing. So you need to understand them. Some common misconceptions of retirement planning are my expenses will suddenly disappear when I retire. It's not true. You will keep on incurring expenses. I can depend on government and my company's pension to pay for my basic living expense. Again, the pension is constant, but the expenses will keep on increasing because of inflation. So you may not be able to do it. My pension benefits will keep pace with inflation. Again, may not be true. There is plenty of time to start saving for retirement. Time flies by. Then you plan for certain thing and then life happens. So the moment you start having income, you need to start looking at retirement planning. Now it is very important to start early. So starting early, compounding is working in your benefit. So to take advantage of time value of money, so if you start at the age of 25, to 65 and you invest $300 a month at 9% interest rate, you will have 1.4 million. But if you wait for 10 years, you have half a million. And if you wait for 20 years to start planning, then you will just have 200,000. So the most important thing when planning for retirement is time. The earlier you start, the better it is. So this is another look at how much $2,000 investment grows. So time is extremely important. The basics of retirement planning. The thing is, our life expectancy has gone up a lot in the last decade or so. So millennials are expected to expected to live more than 90 years. Japan, already people are living beyond 100 years. So the life expectancy is going up. But our retirement age is not going up. So we retire still at 60 or 65, but we stay on till another 35 years until we are, let's say, 100. So people are spending more years in retirement today. A private pension and the government benefits are most often insufficient to cover the cost of living. Inflation is a big threat and it diminishes the purchasing power of your retirement savings. Now, the step one. So review whatever you have. The biggest asset you have is most people have is house. So if you own it, it is probably your biggest asset. If you have large equity, so what you can do is a very good way to plan for your retirement is build your home equity. So buy a house, take a mortgage, pay it off until your retirement. So when you are retired, you have a house that has a lot of value if the prices keep on going up. So you have two options there. One is sell the house, move to a smaller one, and the difference that you have, you can invest for retirement. Second thing you can do is take a reverse mortgage. Reverse mortgage is based on the house value. Banks will extend you a credit line. The biggest advantage of reverse mortgage is you don't have to pay it back. That amount that bank is extending you, maybe monthly, maybe in lump sum, is recovered from your inheritance. So that's the biggest advantage. You can of course pay it back, but if you don't pay it back, that is still okay. It will be recovered from inheritance. Second thing is, when you take a reverse mortgage, you don't have to leave your house. You can still stay into it, still occupy it, still use it. So a good retirement strategy: build your home equity, pay off your mortgage. Hopefully the real estate market stays strong, the housing price goes up, and when you retire, use that house value either to sell and move to a smaller place and keep the difference in retirement, or take a reverse mortgage from a bank. When you take a reverse mortgage, you can still occupy the house and use the payment that bank gives you. When you can live in the house, you can occupy it, and unless and until the person dies, the bank cannot claim the house. The bank will claim it through inheritance. So if you have a large equity in your house, you can consider taking a reverse mortgage, a loan based on equity in your home. It provides elderly homeowners with tax-free investment income. Another important point, it's tax-free. So whenever you sell your primary residence, that's also tax-free. If you take a reverse mortgage loan that is based on your home equity, that is also tax-free. It is paid back with interest when the home is sold or homeowner dies. Disadvantage: the spending the equity in your home reduces the amount of inheritance left to your family. Then you may also have life insurance policies that can be converted into cash or income. You may have other investments like stocks and bonds that can be used for your retirement. So you generally make a list like this. So this we have seen in money management. You calculate your net worth. So you calculate whatever you have, whatever you own in terms of loan, and you calculate your net worth. Next is You need to determine what kind of spending or what kind of expenses you will incur when you retire. So, spending patterns and where and how you live will probably change. Some expenses may go down or stop. For example, work expense like gas, lunches out will stop. Clothing expenses will go down as you will wear more casual clothes. Housing expenses, house may be paid off, but tax and insurance may go up. Then there is federal income taxes will be probably lower because you will have lesser income. So this is average household expenses in Canada. You can just pause the slide and have a look at it. So how much we spend as a percent on food, on housing, on healthcare, etc. It's given. But other expenses may go up, so certain expenses may actually increase when you retire. Life and health insurance will go up unless your employer continues to pay them. That's very rare. Expenses for leisure activities will go up. You will have a lot of free time, so you would like to spend it being on a lake, doing some water activities, traveling the world. So all these things will go up. Gift and contributions will go up. Generally people are more charitable when they are retired, so that's a big increase. Inflation will raise the amount you need to cover your expenses over the probable 16 to 20 years in retirement. So inflation is the biggest threat. Example, if you have $10,000 now, in 10 years it is worth 8,000, in 20 it is 6, and in 30 it is 5. So your pension that you're getting keeps on decreasing if it is a fixed pension. So generally you can make a list like this. So you can pause this video and take a look at it. So you will see what are present fixed expenses, what are present variable expenses, and how those expenses will change when you retire. Next is housing needs often change as people grow older. Ease and cost of maintenance, nearness to public transportation, nearness to shopping centers, church, synagogue, and entertainment become more important. Staying your present home is generally a preferred alternative. The reason is you actually stay there for a while and you have built a community. So moving away from that in retirement is actually very difficult. CMHC, that is Canada Mortgage and Housing Corporation, offers the following programs to assist. So these are kind of loans or grants that they give. So home adoption for senior independence program, emergency repair programs. So they extend it to repair your house and stuff. So extend a loan. This is generally at a lower interest rate to there are grants to use for home repairs. For seniors who no longer want to live in their homes, other alternatives are you can go for retirement communities. So these are independent living residences for retirees or semi-retirees. So advantage is you are around people your own age, so that becomes important and easy. Life leasing option, you can it's a form of a housing tenure where a tenant is given right to live in a dwelling unit in return for a upfront payment and a monthly maintenance fee. Or you can go for retirement homes. The biggest advantage is they generally provide personal care. So private business that provides seniors various combination of accommodation, support service, and personal care. So whenever you decide to move, you have to be very careful. So when you're moving in retirement, email and write to or call the local chamber of commerce to learn about taxes and economic profile. Check on provincial incomes and sale tax and taxes on pension income. Subscribe to a weekend edition. Call a local community. This is very important. Instead of moving straight away, rent for a while and then see whether you are adjusting or not, and then maybe move in permanently. So we have seen what expenses you will incur, how your priorities will change. Now there are certain helps that the government gives. So you may get public pensions. So Canada or Quebec pension plan, CPP or QPP. If you're staying in Quebec, you get QPP. If you're staying in all other provinces, you get CPP. It provides disability benefit, retirement pensions, and survivor benefits. It is contribution based. So when you are working, you contribute to CPP, generally around 4%, and when you retire, you get payments from it. There is a maximum per year contribution limit. You can collect reduced benefit as early as 60 years. So there are three age groups. The retirement age is actually 65. So generally if you take it around 60, so it is reduced by 30 to 40%. If you take it at 65, you get 100% of CPP for all the months henceforth, and if you take it at 70, then you get a certain bonus for all the months from there on. Old age security, it is not based on contribution, it is based on residency. So you get 100% of it if you have stayed for 40 years. If you have stayed less, you get a proportionate payment. Then guaranteed income supplement, this is generally payable only to low income OAS recipients over 65 years of age. So if your income is generally above 50,000, you don't get it. Survival allowance benefits are paid to widows, widowers, and spouses of OAS beneficiaries who are between 60 to 65 years. Employee pension plans, so you get this from government. So you get CPP, you get OAS. If your income is low, you get other benefits. But if you're working with employer, you also get benefits from employer. Now employer pension is generally means two types: defined benefit, in which the pension benefits are defined, but contribution is responsibility of your employer. So employer will give you how much pension you will get when you retire, but the contributions are not defined. In defined contribution, your pension is not defined, but the contributions are. So employer says, I'll contribute 11% of your salary each year into your pension. Now how much ever it grows, or you add your contribution, that is not my responsibility. If it grows and it grows well, you get higher pension. If it doesn't grow that well, you get lower pension. So in defined benefits, the pensions are fixed. In defined contributions, the pensions are not fixed. In defined contribution, what is fixed is contributions. In defined benefits, the contributions are not fixed. So employer pension plan, a plan that specifies the benefit the employee will receive at a normal retirement age. Employer's contribution is not specified, so it's a defined benefit plan. Employer makes investment decisions for you and their contribution, but your defined amount stays same regardless of how investment work. Then there is money purchase pension plan. So it specifies the contribution for employer and employee, does not guarantee pension, but the contribution is fixed. Vesting is employee's right to at least a portion of the benefit if you leave the employment. So if you leave the company, how much you can take with you, that is vesting. So defined contribution plans include following: employees can defer current taxation on portion of their salary. So whatever you contribute to your defined contribution plan, you take a tax deduction on it. We have seen it in taxation module. So whatever you contribute to RPP, registered pension plans, you take a deduction for it. So you actually are taxed when you withdraw. Examples are money purchase pension plans, employee stock ownership plans, and profit sharing plans. So difference between defined benefit and defined contribution. So it is benefits are determined in advance, contributions are determined in advance, payment in retirement is determined by employer. It depends on investment returns. Vesting period is usually 5 years. If you leave before 5 years, you don't get anything. After 5 years, there is a benefit. In defined contribution, it's generally 0 to 2 years. When accrued greatest wealth occurs at the end of the career, it occurs evenly throughout the career. Funding is done by employer. Funding is done generally by employees and some employer matching. Portability, it is difficult to transfer asset, it is easy to transfer asset. Control of asset is with employer, control of asset with employees. and choices are given by employer. Investment risk is with employer, investment risk is with employee. Administration cost is large in defined benefit, administration cost is low in defined contribution. Deferred profit sharing plan. So companies, when they make profit, they contribute to your pension plan. So it is, they share the profits with you by giving, putting it in your retirement account. So contributions are generally made from employer only. There is tax reduction for the company, so whatever it contributes into your retirement, it can take a tax reduction on it. It is based on company's net income. So holdings are taxed when you withdraw them. Contribution to a deferred profit sharing plan are subtracted from your RRSP contributions. Group RRSP. So group of employees can come together and start a RRSP. So it is property of employee, can take money out if you need it. Participation may lower payroll tax withholding. Portability of pension plan. So legislations are there that enforces right to transfer pension credits from one employer to another. There are three options. You can leave your pension in your retirement account and start getting pension when you retire, or you can transfer it to your new employer, or you can transfer it into a lock-in RRSP. So when I leave my employment, I can either leave my pension with the university, and pays me pensions on when I retire at my retirement age, or I can take those pensions and start with a new employer, means transfer it to the new employer, or third part is I can put it in and locked in RRSP. Personal retirement plan. So these are plans that you start to manage the difference of what you need and what you're going to get. So generally we plan for retirement in RRSP, and RRSP is an investment vehicle that allows you to shelter your income tax. So you don't pay tax right now, so you get a tax deduction right now, but you pay tax when you withdraw. Not a specific amount investment, but a way to register a variety of investment to shelter funds. Eligible investments are guaranteed funds, mutual funds, life insurance, and life annuity products. Registered retirement means there are different types. So regular RRSPs are generally opened with banks, and they invest only in banking products. Self-directed are generally opened with an investment broker or a mutual fund company. So you can invest in all different categories. You can also open a spousal RRSP in which you contribute on behalf of your spouse. So spouse is named as beneficiary. There are contribution limit. You cannot contribute as much as you want. So it is 18% of your salary, and the maximum is 26,000, whichever is lower. 18% of salary or 26,230, whichever is lower. This contribution limit is reduced by whatever you are already putting for your pension in with your employer, that is RPP contributions, and whatever you don't use, you can carry it forward for next years. Now when you retire, you can use your proceeds in different way. So if let's say I retire with a $1 million retirement fund, now first option is I can fully withdraw it. So I can withdraw 1 million and put it in my savings account, but I will have to pay a very high income tax, because that entire 1 million will be treated as my income. Or I can convert it to an annuity, so it keeps on paying me monthly or bi-weekly, whatever I want. So an investment that pays a fixed level of income on a regular basis for either a specified period of time or until death. So taxes are very high if you withdraw. That's there. Advantage of annuity: income payments until death. Sometimes if you go for life annuities, it is level payment, it is simple, there is no record keeping, it is a legitimate tax shelter, so you don't pay tax on entire amount, you only pay tax on whatever you're getting. So tax free transfers are there between different plans if you shift from one plan to another. Less control over investment, less control over income payout. There is no inflation protections unless it is indexed to inflation. There is no growth for opportunity, no opportunity for growth, no tax deferrals, no lump sum payments possible, no protection for spouse unless it is joint, and no estate planning benefits. Options of annuities are life annuities or fixed term. So life annuities means full amount of your RRSP fund will be transferred directly to the life insurance company. Convert those funds into a lifetime income payable to you. So what happens when I retire? I take those funds, I give it to an insurance company. I lose control of those investments. They are now handled by the life insurance company, and they keep on paying me a monthly payment. The moment the person dies, it is not transferred into inheritance, so whatever is left, it's lost. Fixed term annuity, the funds are converted into an income stream to be paid out for a fixed term. If you die prior to the end of the term, the remaining unpaid funds will be paid to your estate or beneficiary, so that's an advantage. Then, if you don't want to lose control, you can also manage funds on your own. So, whatever 1 million I had in my retirement account, I can manage that 1 million. But there are restrictions. The government says you have to withdraw a certain percentage each year. You cannot keep the entire fund as it is invested. You have to withdraw a certain amount. So you can convert those funds into a registered retirement income fund where you take the decisions of managing it. Withdraw a minimum amount from the plan until you reach 71, and it increases incrementally to 94 years. You can adjust the amount and frequency of payments you receive, so you have more control. Life income funds or LIFs withdraw a minimum amount every year, and there is a maximum withdrawal amount also. You must be able to purchase life annuity at the end when you turn 80. Other way of saving is a tax-free savings account. So tax-free savings account were introduced in 2009. You must be 18 years or older to start it. The biggest advantage is whatever you invest, it goes tax-free. So even if I invested 100,000 in some stocks and put it in tax-free savings account and they go to $1 million, I don't have to pay tax on that. Contributions are not tax deductible. Plan grows tax free. No tax upon withdrawal. There are limits of how much you can invest each year. So current limit is 5,500 and it is indexed to inflation. So when you are retiring, be sure of these things. Be sure you are receiving all income you are entitled to. You may need to make some changes in your spending plans. Take advantage of all tax savings and benefit available for seniors. You may work part-time after retirement. Be aware of how that earning affects your public pensions. Investing for retirement, so generally when you retire you go for low yield safe investment. It must earn enough to keep up with inflation. Dipping into your nest egg, withdraw savings with caution. You need to maintain enough to continue to live comfortably. You may need to leave some in your estate to your inheritance. Major sources of public pensions. So advantages in planning, it is forced savings, portable from job to job, cost is shared with employer at retirement. Inflation adjusted survivorship rights generally. Disadvantage, increasing economic pressure on the system as population ages. So minimum retirement age is specified. Earned income may partially offset benefits. Employee pension plans, in planning, forced savings, cost is shared or fully recovered by employer. At retirement, survivalship's right. Disadvantages, may not be portable, no control over how funds are managed. Cost of living increases and may be provided on a regular basis. Individual savings and investing, so you taking control In planning, you can invest in RRSPs, easily incorporated into family, portable, control over management of funds. At retirement, it is inflation resistance. You can invest it to earn more than inflation, can usually use as much of fund as you wish when you wish. Current needs compete with future needs. Penalty for early withdrawal. Some sources are taxable. Mandatory minimum withdrawals and restrictions. In planning, special earning skills can be used as they are developed. So means post retirement employment. At retirement, it is inflation resistance, but technology and skills needed to keep up may change rapidly, and health may not allow you to work. So that is the entire recording of retirement planning. We'll catch up in next recording.